This is China Gateway 360. Still pricing loans by LPR? Think again.
90%. Yeah, you heard that right. That is the massive share of new Chinese bank loans currently priced off the loan prime rate, or LPR. But things are shifting. The PBOC is actually engineering a move away from this single rate, heading toward a more diversified, overnight anchored framework. Now, why does this matter? Well, if you're a foreign firm budgeting your financing costs for, say, 2027, this is a big deal. It fundamentally changes exactly how and when future rate cuts are actually going to hit your P&L.
So, where are we seeing this? Take a look at the PBOC's August Q2 Monetary Policy Report. The policy pivot here is pretty clear. Policymakers have quietly dropped the old goal of reforming the LPR. Instead, they're prioritizing a push for diversified loan pricing benchmarks, and they're putting a much heavier focus on overnight rates.
Historically, LPR adjustments happen just once a month on the 20th, and that created a pretty sluggish delay in transmission. But now, the central bank is injecting liquidity directly via the 7-day reverse repo, specifically targeting the DR001 overnight rate. What this does is essentially bypass that whole old system. It creates an immediate, undelayed pass-through straight to your actual corporate borrowing costs.
China Gateway. Gateway.
Your gateway to business in China.
And honestly, policymakers are forcing this faster channel out of sheer necessity. If you look at the data here, despite official LPR reductions over the last year, real-world credit demand has essentially just flatlined. That weak demand basically blunted the effect of those earlier administrative cuts, so the central bank was really forced to find a faster route to actually stimulate borrowing.
Now, your actual exposure to this benchmark transition is going to vary sharply depending on the specific financial instruments you hold. Short-term trade finance, for instance, is going to reprice almost immediately. That brings high volatility and a lot of sensitivity to daily overnight shifts. On the flip side, multi-year term loans, like a standard floating rate facility, well, you might not see this benchmark migration at all until it's time for a formal renegotiation or renewal.
There is also a really crucial currency angle here. The PBOC's moderately loose stance is keeping direct RMB overnight borrowing extremely cheap right now. Historically, US dollar financing was the attractive route for China operations, but this sustained cheap overnight renminbi is really narrowing that spread. When you factor in cross-currency swap costs, the economics are increasingly flipping in favor of direct local borrowing. So, what does this all mean for your finance team? Let's talk operational playbook. First things first, go reread your pricing clauses immediately. You need to confirm with your bank exactly which benchmark is driving your next repricing date. Second, hedge any floating rate exposure you just cannot tolerate. It's a great time to consider fixed rate or swap hedge structures right now to lock in today's favorable, low absolute levels.
Finally, you've got to adapt your daily operations. Make sure to add the DR001 to your treasury dashboards. A sustained spike there is now your absolute earliest warning signal of tightening liquidity. Also, revisit your cash pooling mechanics. Any surplus renminbi is going to earn significantly more in money market instruments than just sitting around idle. The bottom line is that the era of the predictable monthly LPR is ending. The question is your treasury team agile enough to navigate daily overnight volatility? Like, comment, loan, and get the guide.